Principles of finance, a la shmup. From dilution to accretion. All right, people, so now that you have a basic understanding of accretion and dilution, well, let's see how these concepts come into play now that the dust has settled on Blade Runner's acquisition of Nanodrone. Yes, drone wars in a galaxy near away. All right, the transaction is done, and the armchair banker quarterbacks who didn't get the deal grouse that either Blade Runner overpaid for the deal, of course, because they had lousy banking advice, or that Nanodrone sold itself cheap, of course, because they had lousy banking advice. So then the question here is, how much could Blade Runner have paid for Nanodrone, and had the deal work? That is, could the deal have been positively valuable to Blade Runner beyond the price they paid? Like, did they get a bargain here at $600 million? Well, the biggest issue revolves around how much and on what year's earnings the company cared about suffering dilution. Is this accretive versus dilutive smackdown discussion short-term or long-term greedy? Okay, so recall that in year one, Blade Runner was trading at roughly around 25 times this year's current earnings this year, and about 20 times next year's earnings. And when it bought Nanodrone, which had no earnings, zero, like it was growing revenue super fast, but plowing all of its profits back into growth, well, Blade Runner paid infinite times this year's earnings because Nanodrone had none, and probably infinite times next year's earnings, and the next, and maybe the next, because Nanodrone at the time had no intention of having any earnings. They just wanted to be like Amazon and only grow revenues like the wind, period. And since anything times zero is zero, well, Blade Runner paid anything times earnings when it brought Nanodrone. Dilutive. So yes, on those metrics, that's dilution. Or said another way, on this year's numbers, Blade Runner was buying Nanodrone as a dilutive acquisition. Remember that on $30 million of revenues, Nanodrone had no earnings. It'd be dilutive by any stretch if all short-term greedy investors cared about was this year's earnings. Okay, but what about year two? Well, it was pretty obvious and uncontested that as a standalone, Nanodrone would have had $45 million of revenues and maybe no earnings the next year. If they wanted to have earnings, they probably could have had 10 or 15 million if they wanted them and plowed less into growth. But their intention was to plow all those earnings back into growth, and they probably would have. And if they ran the same profit margin structure as Blade Runner, well, they would have kicked out some earnings. So you have to kind of adjust strategic differences when companies are standalones as opposed to a division inside of a large company. Like, Google has a gazillion divisions and each one runs at different margins and different growth rates, right? So at $15 million, if it kicked out the most earnings, giving benefit of the doubt to the target Nanodrone there, at a $600 million price, well, Blade Runner was paying 40 times 1 year forward earnings of that $15 million, right? 40 times 15 is $600 million. Well, Blade Runner as a standalone was trading at about 20 times earnings of year two. But note that Blade Runner was about 10 times the size in earnings of Nanodrone on a 1 year forward basis, i.e. way bigger. So what would have been the weighted dilution then of the combined companies 1 year forward? Of the combined company, you had a tenth of it at 40 times earnings of that $15 million, that's the 600 there, and 9/10 of it trading at 20 times that forward 1 year earnings number. See the weighted averages here? Take a look at just some guesstimates of how things might have shaken out as a combined set of companies, and that little pie thingy there cleverly stands for profit. Well, the easiest way to figure out the new multiple is to just add up the total new shares outstanding and then put the newly combined earnings in the numerator. So it's a $6 billion company buying a $600 million company with cash. Well, the $6 billion company will have produced $600 million in profits in the out year when Nanodrone produces $30 million according to our little model here. Note cleverly that at that point, Nanodrone will be 5% of the total company's combined profit contribution, and it'll be growing dramatically faster than Blade Runner will at that time. So early on, when Nanodrone's earnings are a rounding error of Blade Runner's, well, this acquisition was dilutive. But by the time the out year comes along, assuming all the estimates get hit, if not better, well, then this acquisition is accretive from that year's perspective. All of this is a simple way of assessing whether or not you use your precious capital wisely, and you have to think about what year you're managing the company for. Like, is it for this year or for 3 or 4 or 5 years out. And nobody pays a price that's dilutive to their own company 3 or 4 or 5 years out. That is, if they're paying a high multiple relative to their own multiple, they're making a bet that the target that they're acquiring is going to grow so much between now and then that it will then be accretive to the overall company's multiple. And obviously, well, you could have bought a fleet of corporate jets here for $600 million, which after 4 years would assuredly be worth less than a third of that number. When in doubt, you always want your investing prowess to be compared with buying a jet. The reason that all this analysis isn't worth a ton of effort, though, is that there are two big factors messing with the numbers, so there exists no precision, only general directionality. Wait, didn't Yoda say that? So there are synergies, i.e. firings to be done to improve profit margins, and B, well, nanodrone should be growing a lot faster than Blade Runner now, at least for a while. Both revenues under Blade Runner's distribution and profit margins under Blade Runner's scale should be, quote, lifting, unquote, the rates of Blade Runner. All right, so let's move on to year 3 and take a little look here. Our prognostications for year 3 earnings fully adjusted for synergies under the wing of Blade Runner were fat. If we focus on 3-year out earnings, well, the deal actually appears to have flipped from being modestly dilutive to being modestly accretive to earnings. And it makes the company the one-stop shop juggernaut in global drone sales. That fact alone should carry a meaningfully higher equity earnings multiple going forward, like Wall Street itself believes in the very long-term story of toy drone buying by geeks and non-geeks alike, and maybe the overall company has a 30 times or 35 or even 40 times earnings multiple now that it carries so much heft in the marketplace, and investors see so many opportunities for it to add features like home delivery services and glow-in-the-dark thingies and solar charger power thingies, and maybe you get a bunch of them together and you can haul your kids to school and literally drop them off there. So all kinds of growth opportunities that appear on the horizon when it's the dominant player in the world all come together to give the company likely a higher PE ratio or trading multiple on the street. So that's dilution and accretion, not to be confused with dilation and secretion, which usually occurs when you start sweating in a darkened room.